All right. Well, thank you everyone for attending this month's market update webinar for the month of August. We will start with some disclosures. Silverstone Financial LLC, as a registered investment advisor, information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything discussed within the presentation. And of course, past performance is not a guarantee of future results. You can see our website for additional disclosures. And throughout the webinar, feel free to submit any questions you have using the Q&A button at the bottom or potentially at the top. Zoom has moved some buttons around in the past. Any personal questions or concerns or anything that relates to a client account question, feel free to email us at our team email. Quick about us. Silverstone Financial is a fee-only fiduciary, independent, comprehensive wealth management firm. We provide lots of services, including financial planning, investment management, tax prep, estate planning, and so on. You can learn more about us on our website. And then Gordon and I are the two lead financial planners here at Silverstone. I specialize in inheritance, gifting, estate planning, that sort of thing, while Gordon specializes more on the retirement planning side and helping you invest in a values-aligned way. You have anything to add, Gordon, or should we hop into the presentation?
Let's go right to the presentation.
Awesome. So I'll start the presentation, and apologize if I have a couple coughs. Getting over a cold from last week. So I'll start with the past performance. For those that are new, I see a couple new faces or names in the webinar. I love this type of visualization of the stock market. It's called a heat map. The greener the square, the higher the returns for the period. The redder the square, the more losses for that period. Each of the squares is a different company. So the larger it is, the larger the company is, at least the more valuable of a market capitalization it has. And it's sorted into the 11 sectors of the economy, and then broken down further into various industries. So you can see technology in the top left, materials, so like mining or chemical manufacturers in the bottom right, and you have anything from financials to utilities to energy, which is mostly oil and gas, real estate, healthcare, industrials, and so on. So why, from a financial advisor standpoint, why we love graphs like this is it helps visualize trends. You can see that clearly there's some trends going on in the past month of July, that there were some losses, not specific to any one name, but to a lot of companies in the software space. You can also see that these really large companies have slightly outperformed. They're greener than some of the smaller companies across the board. And some of those nuances are lost when you look at some of the headline indice numbers. So like S&P 500, well, the S&P 500 returned 2.22% in the month of July. Well, that loses a lot of nuance of, well, you can see that actually a lot of those returns were carried by the largest companies, which we'll have more to discuss later this in the presentation, where we talked about how Nvidia has hit quite a large milestone and has been carrying a lot of the market performance for the past couple of years. So with that quick summary, you can see that the S&P top 50, so the 50 largest companies in the S&P 500, top 10% of them returned 3.2%, whereas smaller companies returned 1%. And the S&P 500 is kind of in between those two, so it's not surprising to see it performing in between those two. So again, larger companies this past month have outperformed. S&P GARP is the S&P 500 index that tracks a growth at a reasonable price investing style that we prefer. It has a more of a skew to small cap companies and more value oriented, high quality names. And so they underperformed in the month of July. Again, a lot of the performance comes from these high flyer, very large tech names, which are not included in some of these other indexes. Bonds and ex-US, so non-US stocks, non-US companies, were mostly flat, technically slightly lost, 10 basis points of 0.1% or 15 basis points, 0.15%. So we see a little bit of a reversion to the beginning of the year when we saw the new administration take over, implement a lot of America First type policies where there were tariffs put in place and other kinds of restrictive trade covenants. And that led to a lot of investors fleeing US markets. And we saw a lot of ex-US, so non-US stocks perform quite well. So with that, it'll fluctuate back and forth. And in July, it seems that the US has become now more popular in the eyes of investors, less investment in foreign companies and more investment in domestic companies. We also see gold up about 1% for the month of July. Crude oil up 6%. Again, crude oil and also Bitcoin, these are very volatile asset classes, but they did jump a little bit, a good amount in July. With that, yeah, go for it, Gordon.
I just found it really interesting that there's a lot of green on the utilities category over here at the same time while we have these tech stock growth. And so I feel like there's a little bit of a tug of war between investors riding the growth stocks and some that are kind of pulling back a little bit. Utilities are often a place where investors go when they're worried about valuations being too high in other places. So yeah, a lot of growth over in the utility side. And then the other thing I found really interesting here was Berkshire being down 1.79%. With Warren Buffett announcing his retirement a little while ago, I feel like maybe that's maybe something just unique to Berkshire that's going on there, rather than any fundamental in their industry. But Berkshire being one of the 10 biggest companies in the country, I believe, that's a bit of a driver there on the Dow and industrials in general.
And we won't see Warren Buffett retire until his tenure actually ends December 31st of this year.
Right.
So we could continue to see some interesting behavior around Berkshire since it's very much, there's a lot of good companies in its portfolio, but it's very much a one name, Warren Buffett company. So we'll see if how much disruption we'll see with him fully actually retiring. I'll also add for the utilities, that is a good shout about how usually utilities are seen as safety. So when utilities go up, usually you expect growth stocks to go down. But this also could be an uncommon trend or a trend that has to do with AI, where AI has huge energy demands. We see a lot of these large tech companies like buying entire nuclear plants and such. And so it's possible that some of the energy demand has raised not necessarily the intrinsic value of these utilities, but intrigued some investors. And I don't know if we'll see a reversal or if this is continued growth. We'll see.
That's a really interesting point because, I was noticing, not to get too much in the weeds here, but, solar has done well also. Some of these names in the utilities are that category goes beyond oil and gas, and now it includes, wind and solar companies and traditional utilities, just Duke Power or whatever, that's adding capacity
Yeah, Duke's right
in
here.
renewables.
Yeah.
Yeah, there it is. DUK.
Yeah, we'll see. We'll see what happens. Some of the ESG SRIs, these environmental type of investing, is a little bit less in vogue with the new administration and some of the culture wars there. But a lot of these tech companies, from a pure business standpoint, want renewables as what's supplying their data centers, simply because oil is volatile and they don't want a volatile line item on their P&L. So it could be we'll see more nuclear, solar, wind, hydro, that kind of stuff in the future.
Mm-hmm.
Since we spent a lot of time on the last slide, this is the year-to-date chart. So it's the same as the last chart. This is just month of July. This is month of July, including also January through June. And you can see that the S&P 500 and the S&P top 50, it's actually kind of interesting. I don't believe I made a mistake. I can double check, but they're the same. That's actually really curious. So I do want to double check on my other screen here. But we can see that some of the small caps have underperformed, but a lot of like Nvidia and in Meta have carried a lot of the returns for this year. But definitely the biggest or most surprising or the biggest trend that we see is this global ex-US. Again, 17% returns year to date for non-US companies. Even though this month we saw it, that trend slow down, it's still, a lot of investors wanting diversity or diversification away from US markets. Gold also, fear of inflation or other kinds of fear that governments might be less stable. Gold will rally. Bitcoin kind of in line with gold. Yeah, it's definitely interesting to see. Anything to add, Gordon?
No, it's yeah, for a good part of the year, ex-US was double digits above the US markets, and so US markets caught up and somewhat, but yeah, it's been a phenomenal year for the Eurozone in particular.
Yeah, I do want to confirm. So it's 8.27% year-to-date return for the S&P top 50, and is 8.34% return for the S&P 500. So when you round, they're the same, but technically the S&P 500 is slightly by 7 basis points outperforming the top 50. Yeah. Wonderful.
Mm. Yeah,
Yeah.
some of the mid cap sectors had uh, a good run also.
Yeah.
So some of those smaller S&P 500 companies.
Yeah. Yeah.
Okay.
This is another graph that I like to show each month. This shows the average monthly returns of the S&P 500 broken out by month specifically. So it explains the cyclicality and the seasonality of the stock market. A lot of people don't know that there is normal trends of the late Q3, September and August, historically underperforming some of the other parts of the year. A lot of people have heard the Santa Claus rally in December. So you see November, December having some better performances. Again, these are averages over 100 years almost. So any specific year doesn't have to follow this trend, but it is nice to show breaking out by month and looking back what we have seen for this year and what is kind of normal to see. The outer ring here is the historical average return of the month. And then the inner circle is what's happened so far. So we just finished up July. Normally July is an up month. We did see July returning 2.2%. And then Historically speaking, August and September are weaker months. Now, there's nothing to panic about. And you can also see that April and March didn't necessarily follow that trend. Now, there was new administrations, there were tariffs put into place. There are other events that affect, of course, what a month's returns might be. But we'll see what August and September end up doing for us. It would not be surprising if we see a little bit of a cooling off for the next few months, and then we see a rally at the end of the year. Of course, that assumes there are no nukes being sent between us and Russia or any other kind of black swan events that could happen. Anything you want to add?
No, thanks.
So I like to show the daily S&P 500 charts each month. This is what's called a candle chart. So if it's red, that day returned negative returns. If it was green, that day was had some positive returns. The larger the candle, you can see that means there's more price movement that happened that day. And the smaller candle usually is showing low volatility, calm returns, which we saw before the election. And then we saw with tariffs being announced, very jagged candles, very jagged days of volatility, fear, and such, and lots of calls for us advisors with clients that had some more concerns with their portfolios. Now that tariffs have the markets have digested them, understood. Well, I won't say understood them better because they flip flop around quite a bit, but the news being less scary to at least a lot of institutional investors, we saw a lot of those fears go away, which means we saw a lot of returns come back in and still solid performance since I had originally drawn these lines back in April or May, I believe. It's important to note, there's not much to say here. We can't predict the future. We can't necessarily say, oh, well, we're here, which means we obviously have to go up, or we're here, which means we obviously have to go down. What's more important to talk about is staying with sticking in the market, not trying to time the market. We definitely had conversations with clients who wanted to sell right here. They thought the world was ending, and those fears are totally valid and understandable. And some of the clients did sell, and some of the other clients, we talked to them and they were able to hold on. And if you sell in April and then want to buy back after everything has calmed down in June, you've locked in those losses. And those are some of the hardest returns to get back. It's when you have all the volatility, and knowing or wanting to buy in when it's scary isn't necessarily the easiest thing to do. So we like to preach calm, prudent, indexed passive investing. Anything you want to add, Gordon?
No, it's a perfect learning experience there. What happened in April to get greedy when everyone else is fearful and fearful when everyone else is greedy.
Yeah. All right, so we'll start getting into some news. I think we have 5 slides worth of news. The big one, or that we've given 2 slides to, mostly because we found some pretty cool graphics about it, was that Nvidia hit the $4 trillion market cap. So the company's worth $4 trillion. It's the first company to do so. This left graphic here in the dark green is Nvidia. And then you have Amazon in blue, Alphabet or Google in this red, Microsoft in orange, 3.8 now, and Apple in yellow. And for a long time, we know that Apple was the number 1 company, followed closely behind by Microsoft. But ever since this AI boom, of course, Nvidia has been outperforming for decades. But especially since the AI boom came out, and then all the companies decided, well, they really need all the new AI chips that have huge margins. Nvidia has really jumped quite a bit, and you can see it now topping the 4 trillion market cap valuation month, or market cap value of the company. This graphic here is really interesting to see is Nvidia's contribution to the to the market return. So this is Morningstar large mid index. So you can kind of think of it as the S&P 500, pretty similar of an index. And the dark green are the returns or losses that Nvidia itself contributed to the index as a whole. So in Q4 of 2023, you can see let's call the S&P 500 returned about 12%, and then it returned about 10% in Q1, and all these gains, which lines up right here, you can see Nvidia dragging up and contributing was at 2.5% to the entire market's performance. Huge. You can see other sections, Q1, that's the other fearful part of having such concentrated indexes like the S&P 500. Nvidia falls, it definitely drags down the market with it. It's kind of scary. Anything you want to add here, Gordon?
Well, Microsoft actually today just barely eked out over 3.9 trillion. I'm looking at another website here, but they're close behind, and then there's a big gap, obviously, there between them and Apple at number 3.
Yeah.
Yeah, not that long ago, I forget if it was Microsoft or who was the first, maybe it was Apple was the first $1 trillion company and now the top 11.
Yeah, I think it was right here. Apple crossed 1 trillion in 2018. So
Oh, there you go. Yeah.
I can try to
So,
zoom in a little bit. I don't know if this works on your guys' screens. I think it does.
yeah.
So you can see that. And then right after that, I think that's Amazon in dark blue that touched. Yeah, Amazon
Yep.
touched 1 trillion right after.
Yeah.
Oh, okay. We zoomed down a little too far. There we go. So 2 more just graphs to try to put it into perspective. This left one here is Nvidia's market performance since it IPO'd in January 1999. It IPO'd at $12 per share, and cool 425,000% return later. We're at today, where of course, it makes the S&P 500's 765% returns look like a flat line. So clearly, Nvidia has done quite well. An interesting fun fact that I had heard, a couple months ago on a podcast that stuck with me was Enron, when it went belly up because of all the fraud and got kicked out of the S&P 500. Do you know what company replaced it in the S&P 500? It was Nvidia.
Sounds like it must be Nvidia.
Yeah. And so it's interesting to think about how sometimes, and I'm not recommending it, or it's mostly a joke here, but sometimes fraud can lead to better returns for the S&P 500 because you kick out Enron, you bring in Nvidia, which has done incredible things for the S&P 500. Right graph here is another kind of crazy one to look at, where this is Nvidia compared to countries' stock markets market capitalization. So the company Nvidia is worth more than all the at least publicly traded, I believe all based on even private companies based on this data. I'm not 100% sure, but worth more than all the companies in Canada combined, worth more than all the companies in the UK combined, almost worth more than, or almost worth equal to Hong Kong's stock market, almost worth as much as India's stock market, only $2.3 trillion away from the entirety of Japan's stock market. It's kind of crazy to think about how this one company is rivaling these massive countries. And it kind of puts into perspective a little bit. Anything to add?
What's the market cap of this whole US stock market?
I think it would make this pretty small, but just adding up the top five. You got 3.9 plus 4. You got
It's 62.8 trillion.
yeah. So it'd make this
Wow.
look a little smaller if you include the U.S. But um, yeah, U.S. definitely knows how to make companies and makes them valuable. Of course, there is a little bit of a premium associated with U.S. markets. So if Nvidia was a Chinese company, even if it was producing the same revenues and was exactly the same in all ways, Nvidia would be worth more if it was a U.S. company. So there is a little bit of a premium associated with that, but still crazy to think about.
Yep.
All right, so some more notable events. Since we've been going for half an hour here, I'll try to not spend too much time on any one event. This slide, we've given it to Elon Musk and his various companies that seem to definitely take up a lot of news headlines. So SpaceX, of course, owned by or founded by, or I'm not sure what Elon's proportional ownership of SpaceX is now, but they invested $2 billion into Elon Musk's XAI, which, of course, I believe last month in June, maybe I might be a month off on that, but XAI merged with X, which was formerly known as Twitter. So Twitter and then XAI came together, and then now SpaceX is investing into XAI, and it's kind of all interesting how all his various companies, some private, some public, some startup, some not, are all kind of merging together and or have some sort of combined ownership or services back and forth between them. Not to be too cynical, but there's probably lots of good tax reasons for it. Where, if you are trying to move money out of a public company to a private company, or vice versa, or trying to get this company have a big tax loss or tax gain, there are probably good tax reasons. I'm sure Elon, being the richest person in the world, has great tax advisors. There might be more to the story than just they invested 2 billion. It might be moving money between companies for various reasons. Also, the more that his companies are intertwined, the more it makes him more invaluable to each company, harder to get rid of them, more board control seats in between these companies. So it's definitely interesting to see various of his enterprises get more linked between each of them.
He owns 54% of SpaceX.
There you go. So a controlling stake. That's
Mhm.
the headline there I'm hearing is he controls SpaceX. And my notes here say that XAI's merger with X now values the combined company at 113 billion, with the Grok chatbot now powering Starlink support and eyed for future integration with Tesla's Optimus robots. So, not surprising to continue to see that connect. Um, Going over to the Tesla news, we saw Tesla last month, I believe, launch its self-driving cars in Austin, Texas. Now, of course, the self-driving part is somewhat misleading. There's no one in the driver's side car in the driver's seat, but there is a monitor, a safety monitor in the passenger seat with a kill switch. So it's not the same as Waymo, so Alphabet, Google's Waymo subsidiary, who operates truly self-driving. There's no one else in the car. There's more privacy, which riders have said that they prefer. Actually being able to talk on the phone or with your friends without another person, a stranger in the car with you. Of course, a lot of this comes down to the technology choice that Tesla chose back many, many years ago, claiming that full self-driving was perfectly possible with just cameras versus Waymo having many more sensors such as LiDAR, radar, other kinds of sensors that lead it to actually be able to be fully self-driving and not get into what this next headline here is, fatal autopilot crashes. So back in April 2019, there was a person, George McGee, was driving his Model S in Key Largo, and apparently he dropped his phone, looked down to pick it up, and the car was in autopilot, self-driving, but it blew through a stop sign, and crashed into a parked Chevrolet Tahoe, and ended up killing 22-year-old and her boyfriend, who were standing next to the parked Tahoe. And so fast forward 6 years later, because these things take a while, Tesla was found liable by a jury, partially liable, 33% liable, for the crash, and awarded the plaintiffs 129 million in compensatory damages and 200 million in punitive damages, for a total of $329 million. Now, this isn't the only time that we've seen Tesla's autopilot get into some problems. In recent months, Tesla settled 2 similar cases for undisclosed amounts. And it's interesting to see that they didn't or couldn't, or for whatever reason, had to go through a public trial instead of settling this so that people didn't know how much money they could get if they knew someone that got injured in an autopilot accident. And then the last story here about Elon and his various companies was, of course, we've spoken many times in multiple past months webinars about Elon Musk's pay package getting held up in court and denied by a Delaware state judge. Since then, Tesla's board has now awarded Elon Musk an interim pay package of 96 rather, apologies, 96 million shares, which is worth about $29 billion. And the company pay package, those shares vest over 2 years, as long as he continues being CEO or another key executive position. And if, for whatever reason, the legal battle changes in the 2018 compensation package that would give him $56 billion, becomes a reality again, this current $29 billion package would be forfeited for in lieu of the larger pay package. So it's definitely interesting to see Elon not only being the most valuable man in the world, but also the highest paid CEO in history. And there are still continued desire by the board and other investors to see that be a reality. To be fair, a lot of the board seats are controlled by Elon Musk, since he owns a third or more of the company personally. So very interesting to see all the news headlines about Elon Musk and his companies. Anything you want to add to these stories?
Just a minor correction. I saw, as I was doing some research on these this afternoon, that he owns 15.4% of the company. So maybe he's been selling off some of these shares that he's been getting.
Well, he had to sell a big chunk to buy Twitter. That number that I quoted, I think it's 30 or something like that.
Maybe.
That might have been an old figure, so I apologize.
No worries.
All right, we'll try to go through these, and I'll give I've been coughing a bit. I'll let Gordon take over some of the next ones after this, but wanted to discuss Figma's IPO that happened just a couple days ago. So Figma is a software design vendor company. Helps various software companies, well, design their software before they actually code it out, so they can get feedback from end users and such, and help figure out, okay, well, what is the front end going to look like? That user interface going to end up looking like. So on Thursday, I believe it was last Thursday, Figma IPO'd at $33 per share on the New York Stock Exchange, and it tripled that day. Now, since then, it sold off a little bit, pulled back. Of course, a lot of people, if they triple their money overnight, a lot of them will cash that in and lock that in. So that's not surprising if there's a little bit of cool off since then. But I've seen quite a bit of news and messages on Reddit, other kinds of internet forums talking about how they went to their brokerage houses. I know Robinhood was a big one where they asked to be part of the IPO, and they say, like, for example, I want 2,000 shares, and they end up getting allocated one share. And for those that don't know how IPOs work, it's called an oversubscribed IPO. So an initial public offering, the investment banker that is underwriting the company's initial public offering will figure out how many shares of Figma or whatever company is going to be sold to the public. They buy those shares and they go to the public and they say, okay, let's sell these. And various brokerage houses will be allocated chunks of however many. And if something is oversubscribed, then they have to pay out or be assigned to the brokerage houses and clients in a proportional manner. And so each company or each client would say, I want 2,000. Well, if everyone wants 2,000, then and we only have enough for one per person, then everyone gets one share. Of course, that is one of the reasons. That's how a stock jumps up by 3 times in a single day. That doesn't happen unless it's oversubscribed, unless everyone or a large chunk of the public investors want a piece of that IPO. So, of course, the ones that if you're an investor, you're unfortunately left out of partially, those are the highest flyers, the biggest winners. That probably would only happen with those that are oversubscribed. So it is something to be expected. The only other thing I'll add to the Figma news was that back in 2022, Adobe had agreed to buy Figma for $20 billion. Now, of course, it IPO'd at much higher than that today. But it ended up being, the deal ended up being tossed because of UK regulators saying that the deal would harm design software innovation. So that got scrapped, and then it eventually went IPO. So there is some argument or some praise to be had to regulators preventing big mergers where it would have destroyed some value and destroyed some competition if the merger had been allowed. Of course, for Adobe investors, that is not good news. They would have loved to have that IPO value internalized into Adobe. But for software companies as a whole, I suppose this is a better thing. Anything to add about Figma, Gordon? No.
Yeah.
All right. Then I'll go on to Apple credit card. So for those that have an Apple credit card or know the Apple credit card, they launched 2017, 2018, not sure when, but they launched with Goldman Sachs as their provider. Goldman Sachs at the time was trying to get into retail banking. So they had their Marcus savings and checking account, and they had the Apple card, and they were trying to get more involved in retail banking. Of course, they were a big investment bank on Wall Street. So clearly they thought that they would be able to handle easy retail banking. It's not as hard as what they were doing. Of course, that I'm being sarcastic. Retail banking is actually quite difficult to do profitably, and Goldman Sachs has since lost billions of dollars on this initiative, on a lot of their retail banking initiatives, and so they are trying to get out of it. So they told Apple that they don't want to renew their contract, and that Apple would have to find a different finance company to be the back end of the credit card. So Apple went around to the big 3 players. The big 3 players would be American Express, JP Morgan Chase, and Capital One. And it seems, it's being reported, I think it's the Wall Street Journal reporting it, and it's not officially announced, but it seems that JP Morgan Chase is likely to be the one that is going to take over Apple's credit card program. Now, the reason why it wasn't so cut and dry the first time, Apple was able to impose a lot of their preferences over Goldman Sachs, because Goldman Sachs wanted to get into the industry, into the retail banking industry, and Apple had a huge presence. But now that it has publicly not gone very well for the bank, the partner bank, the other three that they interviewed, I'm sure they interviewed more than the three big ones, but they had a lot more leverage over Apple. So originally, Apple said that there were a few contingent problems that they imposed on Goldman Sachs. They said, well, you can't impose late fees because we want to market it as a no fee card. Um, Another big one is they want a lot of people approved. They want to make a big splash in the credit card name. So a lot of the standards for approving credit card issuers were really, really low. Almost anyone would get approved for the Apple Card by Goldman Sachs. And of course, that led to what's called subprime borrowers, people that wouldn't normally get access to a credit card were able to get access to a credit card and rack up debt that they necessarily couldn't pay back. And of course, there were no late fees, so there's not a whole lot of incentive for them to pay it back. So there are some more delinquent loans in the portfolio of credit card balances that Goldman Sachs holds than a normal bank's portfolio would have. This makes the balances worth less than normal, and that is one of the big sticking points for JP Morgan is they would only be taking this over and paying Goldman Sachs for the balances at a steep discount. So they'd be able to get a lot of these, and because there are these bad loans on there, they would be able to get the entire portfolio at a pretty good rate. Now, of course, Goldman Sachs doesn't necessarily want to lose out on money, but it seems they just want to be done with this side of their business and just cut their losses. Another interesting one that was imposed by Apple was they wanted all their credit card clients to have the same statement period. So they wanted to be on the first of the month was the statement begin date, and the 31st of the month was the statement end date. And from someone outside of the finance industry, that seems perfectly reasonable. But if you go to your Capital One or American Express bank statement, unless you specifically request a specific statement period, which you can do, it's based on when you signed up. And so it spreads out when the statements happen and the different periods happen. And without that, if all of them are on the 1st and the 31st, when the statement comes and if someone has questions, everyone floods the support lines at the same time, which caused a lot of problems for Goldman Sachs reportedly. So that is one of the requirements that Apple is being reported that JP Morgan has gotten Apple to agree to change. But some of the more sticking points is the no late fees, which JP Morgan, of course, doesn't necessarily want to do, and what the dollar amount that they're going to pay Goldman Sachs is going to be. And JP Morgan is going to increase the standards for those being approved for the cards. So a lot of things are going to change about the Apple Card. They kind of have to. It wasn't necessarily a sustainable model, clearly, since Goldman Sachs lost billions of dollars on this deal. Yeah, really interesting to see, and we'll keep you updated as we hear more. Yeah, I think that's it for me, Gordon. Go ahead and take over.
So, yeah, the next item here, India has more billion-dollar companies than France and Germany combined. Really interesting from the perspective of, well, what do different countries emphasize? Germany and to a lesser extent France are suspicious of bigness in their companies. Germany has a word that they use for the most important part of their economy. They call them Mittelstand, which means the middle-sized companies, big enough to have some economies of scale, but not so giant that they start to amass a lot of political power. The exception is or in a couple of industries, most notably autos, where economies of scale are absolutely necessary for success. There's been some consolidation in the German auto industry, but Volkswagen, Mercedes, and BMW, some of the most famous and valuable names in the world of autos. Whereas India definitely doesn't mind big companies, and with a population of over 1 billion people, there's a lot of growth potential for any company that has um, that has a good market share in India. Um, yeah, so that's really all I want to say about that one. Let's move on to, excuse me, to our next item here. Singapore taps JP Morgan. Again, JP Morgan coming in here, and others in a plan to lift the stock market. So when you read that headline, you might think, what is this, market manipulation? The thing is that some of the small country, a very small country like Singapore, liquidity relative to um, other countries with large companies, there's more liquidity, and so you have more efficient markets. And so with JP Morgan and some other global financial institutions are going to be doing is just working on making their market as efficient as possible, by getting more Singaporean companies co-listed on different exchanges, or whatever other creative solutions they can come to in order to just get valuations in Singapore more in line with the multiples that companies fetch in other companies with larger stock markets.
Right.
Okay, so this next item is also has some India connection. They have a crypto exchange, coin DCX, got hacked for $44 million. This was a single criminal. There's a lot of technology news around that I'm not going to get into, but $44 million, not that big of a deal to the company, but obviously a big deal to the people who were affected. Um, just kind of a warning on that not only do you have to vet uh, the cryptocurrency that you may be interested in investing in, but that you have choices with different exchanges, and picking the one that's the most stable and secure is an important consideration. Um, I
And
don't have a
keeping it in
particular.
cold storage, a lot of crypto people will say is like if you keep it on the exchange, you are subject to the exchange's potential security liabilities. But if you keep it in cold storage, means like in a USB stick, not attached to the internet, it's a little more secure. Of course, if you lose that USB stick, or your house goes up in fire, or you forget the password to your thing, there are plenty of horror stories of people literally losing billions of dollars. It just impossible to recover. So there are some issues when the financial institutions go back in the day and don't have the protections that we're accustomed to for FDIC and banks and how it currently works. So there's lots of innovation happening, but you could also see crypto exchange hacks and other kind of issues. You're essentially keeping your money under a mattress. Um, just important to
Exactly.
note.
Uh, So the next item here is around the new cryptocurrency regulations. This was actually one of those rare bipartisan bills um, that was passed, with support from both parties. Um, you know, it's good that we have some things that occasionally everybody agrees need to be done. Big milestone for the crypto industry, and it's called the Genius Act. Of course, our president brings creativity of naming laws to a new high. Um, and it also shows the power of the crypto industry and their lobbying and their particularly close relationship with the current administration. Um, Interestingly, um, some of the aspects of this rule around trading apply to Congress. There's parts of it that forbid members of Congress from profiting from stable coins, but that does not apply to the president. So, and so make of that what you will.
Yeah, it's interesting to
Um,
see the stable coins. I would say in general, having regulations is important for stable coins. In the past, go back 2018, 2019, these stable coins, if you don't know what it is, it's kind of like a money market fund where you give the money to the fund and then they invest it in treasury bills or whatever. And it's safe because it's invested in a safe manner and then you get out interest like a savings account. And that's how normal money markets work, and that's very safe and secure, and we use them with our clients. Stable coins were different, where you could see it being advertised where you get 20% returns, and for just leaving your money in something that's called considered stable. And what they would do is they would take your money and then invest it in other cryptocurrencies that, when they're going up 200%, they can pay you 20% and it works out great. But when that doesn't happen, everything blows up. So having some more regulations into what constitutes a stablecoin and what is secure and that kind of stuff, very important. Again, not necessarily something that's recommended because you don't have SPIC insurance or FDIC insurance or any of these kinds of other actually important things when you're trying to have stable value and just paying interest. It makes it safer than it was, but we wouldn't necessarily recommend it over a traditional money market or savings account. Uh, so I had to throw that in there.
yeah, I mean, just if they're investing in other things, then when you buy the stable coin, you're basically buying a derivative, and that's history doesn't repeat, but it rhymes, and uh, financial institutions are always looking at ways to capitalize on derivatives in one form or another, and eventually they can when things go down, then they can go under.
Yeah.
Um, so the next item here, State Department layoffs scheduled to go forward. This was from July 10th, so almost a month ago, but after our last call. People who are living around here, probably everybody who's been paying attention to the news at all knows that um, there were a lot of layoffs and some were stopped or slowed down by the courts. Um, Most of those have been cleared to go forward as far as I know, and this State Department layoffs are no exception. Um, so, you know, Interestingly, of course, while a lot of those people will be people who live here in DC at least part of the year, like many uh, large government agencies, there are people outside of just Southern Maryland, Northern Virginia, and DC that are affected by these things. Um, Anything to add on that one, Jeremy?
No, it's interesting to see, but it is not surprising based on what's been happening the past few months. Yeah.
Hmm. Were you going to talk about the tariffs?
You can go for it.
Okay. So, you know, again, this is one of those things that probably everybody on the call knows something about. The latest gyration in this the saga of tariffs as a um, well, a few different things. I feel like the purpose of them is multifaceted. Uh, it's not just about our president's economic beliefs, but also it's political in terms of that he made promises to um, improve the trade deficit. Whether that matters or not is, I have an opinion on that, but I'm not a economist by profession, although I did study it in undergraduate. But it's also potentially a negotiating tactic where we've seen um, proposals of high tariffs and then eventually they settle. They negotiate down to something uh, apparently seeming to be more reasonable. Um, the latest is this idea that India will be have a 50% tariff because they bought, excuse me, because they bought Russian oil, and which undermines sanctions against Russia for the ongoing war in Ukraine. Um,
I find that really interesting if I can butt in about
Please.
the oil, India buying Russian oil. For those that attend lots of these webinars, probably know that I find India a very interesting emerging market to invest into. And for those that have read some of my writing back in the day about talking about the investment philosophy or the about behind that, one of the important notes that I had brought up about why India is not the same as a lot of other emerging markets was that they get to skirt international norms for their own benefit because they're in such an interesting political, geopolitical position where they essentially, it was very well known, they were buying Russian oil, whereas like Europe wouldn't be able to because they were following the U.S. sanctions, and there were a whole lot of countries that if they broke the U.S. sanctions, they would get extremely punished. But India is an interesting ally of the United States, right next to China, not far from the China Sea. Like it's in a really interesting place and is allied by the U.S., but also is like on one of the largest allies other than Japan in that area where they're able to kind of, well, I hear you and what Russia's doing isn't great, but I don't care that much as long as I can get cheaper oil. And the US didn't really want to ruin the relationship with India. Now, Trump very much seems to favor, instead the stick over the carrot in these negotiations. So that is definitely one change in the world order, let's say, and the investment philosophy of India being superior to a lot of other emerging markets. And I personally am watching this closely to see, if some of my underlying assumptions are wrong or are changing behind that investment. But I think, like Gordon has said, it is a negotiating tactic. I think they will settle back to something more reasonable. And ultimately, I think India will continue to buy Russian oil without too much issue. Whether that's a good thing or a bad thing, of course, it's not great from a sanction standpoint or for humanitarian how the war is happening in Ukraine. But from India's economy being able to get oil at the same rates or in the same price as China is quite advantageous. Uh, anyway, just want to add that.
Yeah, I mean, India, I believe, is the most populous nation
Yeah,
now.
yeah, they're larger
And
than China. Yeah.
yeah, they have aspirations in the long run to be, um, to do what China has done, grow its economy at a very fast rate. They produce a tremendous number of engineers every year, and in an increasingly multipolar world, India wants to be one of those one of those poles, along with China, the US, and the Eurozone. Um,
They'll probably do it too. Their population, I think, is expected to peak in the 80s or 90s, 2080, 2090 or something. I forget the last statistics, versus like China is already peaking, and a lot of other, like Japan is already declining because of how the demographics are, and the US and the Euro. Europeans are going to be peaking and declining at some point. Like India is really interesting to see, just because of how the population works and the demographics. Like there isn't the one child policy, which seems to have really messed up China's future here. Uh, I think
well,
being successful, hopefully, we'll see. As long as they don't fight again to war with Pakistan, two nuclear powers that don't like each other, or China, another. Uh,
yeah. Um, Climate is a big threat in India,
it's
though.
true.
And
Monsoons, all that kind of stuff.
yeah. So next item here, Fed leaves rates unchanged. Trump threatens Powell again. This has been an ongoing saga. Really, back in early July, Trump sent a handwritten letter to Powell demanding that he lower interest rates, which, the Fed is supposed to be an independent uh, agency and always has been. Presidents have kind of jawboned as the old-timey kind of political description of, when presidents like try to tell people what to do when they don't really have any direct power to make them do it. Um, Nixon was particularly uh, prone to try and tell the Fed what to do. But then it really reached kind of a new high when Russell Vought, Trump's director of the budget office, accused Powell of breaking the law by failing to comply with government oversight regulations and lying to Congress uh, about the renovation of the Federal Reserve building um, headquarters down on Constitution Avenue in DC. Um, and then, then the second headline there, kind of following on the heels of that, the Fed left rates unchanged and did not lower them. Trump suggested that the Fed board, the governors, is it 12 or 14, something around that neighborhood number of members of the Board of Governors, he said that they should, quote unquote, assume control if Powell won't lower interest rates, as if that was an actual, um, you know, thing that could be done. Um,
And it's a vote. It's a Democratic vote, and I think there were two dissenting
right,
board members that said they should lower rates. And I can guarantee you, those two dissenting board members would not agree with what Trump's original plan, which I think was cutting 350 basis points, 3.5%. They probably would have reduced it by 25 or 50.
right,
So of the 12, majority rules. Oh no, Powell isn't doing what Trump wants. They would assume control, and they would continue doing the same thing because that's what the Democratic, not in terms of Democrats, but how the voting of the boards work.
right. And the chairman only has, does he even have a vote?
He has a vote. He definitely is a voting
Okay,
member,
so
but
he has one vote, just like any of the others.
yeah,
He just runs the meeting, I guess. And
runs.
has more of a staff, but um, and his role goes beyond just setting interest rates. Of course, the Fed is also a regulatory body.
The
But
bank regulators. Yeah.
yes, uh, thank you. And so, yeah, even if Powell was replaced, maybe then there would be three dissenting votes.
Well,
Um,
what's interesting is I think you only can make one. You can only like promote. I looked it up a while ago. I don't really remember, but he can't just pick anyone, and say you're the new
exactly.
guy. you have to basically he would pick the most dovish, so the ones that's the most fear or least fearful of inflation, the most dovish member of the 12, and there are a couple choices there, and then he can appoint other people to then take over as I think there are two or three, depends on if Powell retires or not, because he could continue his term as a board member even if he's not, the head. Um, he could appoint a few people, but again, that's 1/4 of the entire board. It is unless President Trump is able to somehow become a president for a third term, he will not ever be able to get control over the Federal Reserve Board, assuming no coups or some other kind of inherent change to the Constitution or how the laws work. That'll be interesting.
Yes. So I expect this fight will continue. There's all the the Fed, conspiracy theorists. Of course, the Fed is audited in different ways. And we know it's on their balance sheet. So yeah, we can expect to continue to see headlines around this battle. Um, unless the economy really gets roaring. But that doesn't seem to be where we are in the business cycle.
Yeah. We'll see what happens. Powell will
Yep.
probably be holding out his term until beginning of 2026 when Trump will appoint or promote someone else. But I'm glad the institution has held up its independence even under threat, and I'm hopeful it'll continue to do so.
And of course, Powell was appointed by Trump.
Yeah, Powell was originally appointed by Trump in the first
And
administration,
and Biden just kept him because
Yeah,
he did a decent job.
he did a good job, and he wanted to reduce the amount of volatility in the Fed. Of course, Trump, that's not one of his concerns. Yeah. All right. Well, that is our webinar. Seems like we went an hour and 10 minutes. Some of these are shorter, some of these are longer. We're definitely, now that Gordon has joined the webinar hosting crew here, we have a few more events we like to talk about, and we go, a little back and forth. So we'll go a little longer than we have in the past couple of years, or that I have in the past couple of years. I don't think we have time for any kind of Q's and A's. Didn't see any that were particularly pressing. So I think we'll wrap it up here. There are, of course, disclosures. Anyone that has any personal questions, feel free to email us at our email address, team@silverstone.financial. And feel free to sign up for next month's webinar if you want to see this live and submit your Q&As. Anything to end on, Gordon?
It's a great discussion.
All right.
And let us know if you have feedback on the format, or is this way too long, or
are we taking too much time?
Do you want us to go into more depth? Of course, we want to be responsive to you, our clients and other listeners.
Yeah, well, we'd love to hear feedback and find ways to improve. All right. Well, have a great rest of your month, everyone. Great night, and see you next month.
Good night, everyone.